The future of finance. 1. Financial inclusion. Cryptocurrencies have the potential to provide financial services to people who are currently excluded from the traditional banking system. With a smartphone and internet access, anyone can access cryptocurrencies. 2. Reduce transaction costs. Cryptocurrency transactions can be more cost-effective than traditional banking or remittance services, especially for cross-border transactions. 3. Security and transparency. Blockchain technology ensures the security and transparency of transactions. It can reduce fraud and provide a tamper-proof record of ownership. 4. Asset tokenization. Cryptocurrencies enable the tokenization of real-world assets like real estate or art. This can make it easier to buy and sell fractional ownership in these assets, increasing liquidity. 5. Smart contracts. Some cryptocurrencies, like Ethereum, support smart contracts. These are self-executing contracts with the terms of the agreement directly written into the code. They can automate complex financial transactions and reduce the need for intermediaries. 6. Hedging and investment. Cryptocurrencies are increasingly viewed as a store of value and a hedge against inflation. Institutional investors and individuals are including cryptocurrencies in their investment portfolios. 7. Challenges and regulation. Cryptocurrencies also face challenges, including regulatory scrutiny, price volatility, and security concerns. Government regulations are evolving to address these issues. It's important to note that the future of finance with cryptocurrencies is still evolving, and there are risks involved, including the potential for loss of funds due to price fluctuations and security breaches. It's advisable to approach cryptocurrency investments with caution, do thorough research, and consider your risk tolerance and investment goals.